My name is Farhan. Today you're going to solve question number 4 from 2016 past exam. This question requires you to prepare the adjusting journal entries and then the income statement. If you need tutoring sessions, make sure to check the link in the description to book a call with me. With that being said, let's get started. Mix M Games sells electronic games. All stock is marked up by 100% on cost. The business prepares reports every 6 months in June and December. So we are given the pre-adjusted trial balance as of 30 June 2016, and then we are given some additional information that we need to journalize. Because the business reports every 6 months in June and December, we understand that the previous reporting date is 31 December 2015, and the current or the next reporting date is 30 June 2016. So within the trial balance, you can see that we are given prepaid sales revenue, stock control, and cartridge in. So these were different terminologies based on the old curriculum. So now we call prepaid sales revenue as unearned sales revenue, which refers to a current liability for the business. Unearned sales revenue means that the business has taken payment in advance and will deliver these goods or services in the future. So at the moment, it's a present obligation for the business because they have taken the payment and is still yet to deliver. So that is why we call it unearned. So unearned sales revenue, which is a current liability. Then we have stock control, which is what we now call inventory, which is an asset account. And then we have cartage in, which is what we refer to as carriage inwards, which simply means cost of transport of goods into a business, which is part of the calculations for cost of goods sold. So let's start with the first additional information. Wages of $2,300 are owing at 30 June. So this refers to accrued wages, which is a current liability for the business. So when liabilities increase, we credit them. And at the same time, this $2,300 of wages has been consumed or incurred as an expense by the business. Therefore, expenses are going up as well. So we have to debit them. So when expenses increase, we debit them. And when liabilities increase, we credit them. So that is why we debit wages by $2,300, referring to an increase in expenses. And then we're crediting accrued wages by $2,300, which refers to an increase in current liabilities. So we're going to do all the workings first, and then we will prepare all our solutions in the outline or the answer booklet. So the second additional information says that the loan interest only was taken out on 1 February 2016 at 8% per annum. No interest has been paid to date. So if you check the pre-adjusted trial balance, you can see that we are given loan of $7,200 on the credit side. So this loan of $7,200 is a liability, and that is the reason behind why this is shown within the credit column. So we are paying interest of 8% per annum on this loan. So let's find the interest on an annual basis on this loan. So we simply multiply 8% on the loan principal of $7,200, and that's $576 on an annual basis in interest. Let's find the monthly interest, which is to simply divide the annual interest of 576 by 12, and the monthly interest becomes $48. We understand that this loan was taken out on 1st of February 2016, and we are preparing all the adjusting journal entries for 30 June 2016. So in between 1 February 2016 and 30 June 2016, we have 5 months in total. And what are those 5 months? We have February, we have March, we have April, we have May, and we have June. So for this 5 months, the total interest expense is $48 on a monthly basis multiplied by 5, which is $240. Now, we understand the question explicitly mentions no interest has been paid to date. So if no interest has been paid to date, this $240 of interest that has been consumed or incurred in those 5 months of February, March, April, May, and June is now a liability. So therefore, we have to credit accrued interest expense to reflect that increase in liability by $240, and then we debit interest expense by $240 to reflect an increase in expenses, which is what's going to decrease your net profit. So let's move on to additional information number 3. Prepaid sales revenue at 30 June is $1,600. Now, we already understand that prepaid sales revenue is the same as unearned sales revenue, which is a current liability for the business. Now, this unearned sales revenue at 30 June is $1,600. Now, check the unearned sales revenue balance that we had prior to the adjustment. And that was $4,100 given within the credit column, because this is a liability, obviously. So from 4,100, now it's 1,600. So there has been a reduction of $2,500. So that reduction of $2,500 in prepaid sales revenue from 4,100 to now 1,600 at the end of the month refers to revenue that the business has actually earned and the services or the item that the business has actually fulfilled or delivered. Therefore, if unearned sales revenue to begin with was a liability, which would have a credit balance originally, would now need to be decreased and therefore debited. So we are debiting unearned sales revenue by 2,500. So I wrote prepaid here. You should write unearned as well, so you understand it's the same thing. And then you're crediting sales revenue by 2,500 because you have earned this revenue. So now you can confidently say that this $2,500 is your sales. So you have to report this within the income statement. Again, debit unearned sales revenue refers to a reduction in liability or the amount of obligation that you had to deliver. And credit sales revenue of $2,500 is simply increasing the revenue of the business, which is what we're going to show in the income statement. Let's move on to the last additional information with regards to vehicles. So vehicles costing $120,000 plus GST were purchased on 1 June 2015. So this is in the previous financial year. Not the financial year, this is the previous year. So they have an estimated useful life of 8 years and an estimated residual value of $24,750. The vehicles are depreciated at a rate of 20% per annum using the reducing balance method. All right. So we understand that the business reports twice, which is in June and in December, at end of December. So the previous reporting period would have been 31 December 2015, and the current reporting period is 30 June 2016. We have purchased vehicles of $120,000 on 1 June 2015, which is almost 2 financial periods before. And given that the business prepares the reports in June and in December, we need to factor all of this into our calculation for depreciation. All right, so on the right-hand side, see what I've done. So first of all, the first reporting period, given that the business purchased the vehicles of $120,000 on 1 June 2015. So the first reporting period will be only for the month of June, which is 1 June 2015 until 30 June 2015. Because the vehicles were only used for 1 month in that reporting period. So if you want to find the depreciation in the first reporting period, although you have a reducing balance basis, you'd simply apply the percentage on the original cost of $120,000. We do not have to subtract the residual value from the cost, which is what you would have done if you were using the straight line method. But that is not what we're doing in this case. So 20% simply applied on the original cost of $120,000. This 20% was an annualized rate because the question explicitly mentions depreciated at a rate of 20% per annum. So what do? Then we multiply with 1 over 12. And the reason we multiply with 1 over 12 is because this means we're adjusting this calculation for 1 month out of the 12 months we have in a year. Because from 1 June 2015 until 30 June 2015, 1 month has passed. So the vehicle is to be depreciated only for this 1 month in that reporting period ending 30 June 2015. So therefore, you first find the annualized depreciation and then you multiply with 1 over 12 to convert it into a 1 month basis. So once you do that, you get $2,000 as the monthly depreciation. Maybe you can also simplify this if you're still confused. Let's say we want to find the annual depreciation, so which is 20% of $120,000, that would be $24,000. And then you divide 24,000 with 12, which gives you the monthly depreciation to be $2,000 in the first reporting period. All right. So it's the same thing. Whatever way you want to take, whatever is easier for you. So $2,000 as the depreciation in the first reporting period, which covers the 30 days from 1 June 2015 until 30 June 2015. So next, we want to find the net book value or the carrying amount at the end of the first reporting period. And this is something we must do every time we are calculating depreciation using the reducing balance method. Reducing balance method requires you to apply the percentage on the net book value or the carrying amount of the asset at the end of the previous reporting period. So this is the main reason behind why we are calculating this now, because we will be using this for the next period calculation. So how do we find the net book value or the carrying amount? You simply take the original cost and subtract the total depreciation or the accumulated depreciation. Now the cost is $120,000 minus $2,000 in depreciation for the first reporting period that we had just calculated, and that gives us a net book value or carrying amount of $180,000 for vehicles at end of 30 June 2015. All right. Now, if you have any questions with regards to why didn't we include GST within $120,000 cost, this is because GST is not part of the cost. GST is what we have to pay, and that goes to the government. So GST is a goods and services tax. It's a tax that is added on top of the original cost of the asset that we're talking about. So GST does not form part of the original asset cost. It is an obligation for whoever is collecting the GST on our behalf, the people whom we purchase the vehicles from, and it's their obligation to pay that GST to the government. And it's our obligation to pay this as the end consumer. So this is not part of the cost calculations ever. All right, so let's move on to the second reporting period. So we understand the business reports every 6 months. So therefore, the second reporting period will start on 1 July 2015 and end on 31 December 2015. So what do we do? If you want to find the depreciation using the reducing balance method in the second reporting period, you take the original percentage of 20% per annum, multiply it with the carrying amount that you had calculated at the end of the previous period of $180,000. And then you multiply 6 by 12, which is the same thing as multiplying with 0.5, reflecting 6 months. And that is $11,800. So let me explain this simply. If you multiply 20% on 180,000, you would have got the depreciation for 12 months. And then you multiply it with 0.5 or you divide it with 2 to get the depreciation for 6 months. So that is why the final answer is $11,800 as the depreciation for the 6 months in the second reporting period covering 1st of July 2015 until end of 31 December 2015. Then you want to repeat the process of calculating the net book value or the carrying amount at the end of the reporting period because you're using the reducing balance method. So we take the net book value or the carrying amount from the previous period, which is 180,000 at end of first reporting period, which you can see here. And then we subtract the depreciation for the second reporting period, and that gives us a carrying amount of $106,200 at the end of the second reporting period. So this refers to economic benefits that are still remaining with the vehicle within the vehicles for consumption or usage by the business. Excuse me. Let's move on to the third reporting period, which covers 1 Jan 2016 until end of 30 June 2016. That's where we are now today. And if you want to find the depreciation again, it's straightforward. You take the annualized rate of 20%, multiply it with the carrying amount that you had calculated at the end of the second reporting period of $106,200. Then you multiply 6 by 12, which is the same thing as multiplying with 0.5 because it's 6 months of usage. And that takes care of the adjustment required for the annualized 20% rate. And you get the depreciation for the third reporting period covering 1st of Jan 2016 until end of 30 June 2016 to be $10,620. Now, if we were to prepare the journal entries at the end of 30 June 2016, we would debit depreciation of vehicles by $10,620, which refers to that increase in expenses and is reported in the income statement. And then we also credit the accumulated depreciation of vehicles by $10,620, which increases the total depreciation for vehicles. So accumulated depreciation is a contra asset account. A contra asset account is a separate account that we create, which reflects the reduction in a relevant asset account, which in this case is vehicles. So that is why we are crediting this. So debit depreciation of vehicles by $10,620, which is what we report as an expense in the income statement, and credit accumulated depreciation of vehicles by $10,620, which is what we refer to as a contra asset, and we show this within our balance sheet current asset calculations. All right, so let's move to the outline that has already been given to us. So let's understand how we can prepare all these journal entries. So you can see the format or the outline that we are given. It includes columns for general ledger and subsidiary ledger. So what's the difference between general ledger and subsidiary ledger? Now, general ledger is the main ledger in an accounting system, and it contains accounts for assets, liabilities, equity, revenues, and expenses. The general ledger, for example, will contain accounts like accounts receivable, accounts payable. So the total or the ending balance that we get at the end of a period, let's say within the ledger account for accounts receivable from the general ledger, is what we use as the current asset balance in the statement of financial position or the balance sheet. So the main purpose of the general ledger is to hold accounts for assets, liabilities, equity, revenue, and expenses. And whatever balances we have at end of the reporting period are basically used to prepare the financial statements of the business, such as the balance sheet and the income statement. Now, the subsidiary ledger is a specialized ledger that contains detailed information. So let me give you an example. Within the general ledger, we have accounts receivable, which is an asset account. But we can have many different types of customers who are added together to give the total for accounts receivable. Let's say we have customer A, we have customer B, we have customer C, we have customers D. So customer A, B, C, D are accounts that we will be showing all the transactions in details in the subsidiary ledger. For example, in the subsidiary ledger, customer A will be showing its all the relevant transactions we've done with customer A, all the relevant transactions we've done with customer B, all the relevant transactions we've done with customer C, etc. But in the general ledger, rather than showing customer A, B, C, and D separately, we just add all of it and combine everything and show the total that we have for accounts receivable as a whole. So this is the main difference between the general ledger and the subsidiary ledger. None of the journal entries that we have done in the additional information has any impact for the accounts receivable, specifically not a singular customer. So therefore, none of the journal entries that we have to prepare today will need to go in the subsidiary ledger. So let's start with the first one then. So the first one was to debit wages. So we are at 30 June 2016. So we debit wages expense within the general ledger, which reflects an increase in expenses. And then we credit accrued wages within the general ledger, which reflects an increase in liabilities. Next, we've got the interest. So again, this is going to be at the end of 30 June 2016. So we debit interest expense by 240, which reflects an increase in expenses. And then we credit accrued interest expense by 240, which reflects an increase in liabilities. All right, so then we got debit unearned sales revenue, and then we have credit sales revenue of $2,500. Let's get that done. So again, at 30 June 2016, so debit unearned sales revenue. Previously, we used to call this prepaid sales revenue. And then we credit sales revenue by $2,500. So when we debit unearned sales revenue, we're reducing our liabilities. And when we credit sales revenue, we're increasing our revenues. The last one is the depreciation, which had a lot of calculations involved. And that is simply the debit depreciation of vehicles by $10,620, which refers to an increase in expenses, and credit accumulated depreciation of vehicles by $10,620, which is a contra asset account and is generally credited. So I'm just going to write depreciation in short, so accumulated depreciation of vehicles. So make sure to write the full form in the exam yourself to get the full marks. So nothing to do really with the subsidiary ledger because it contains detailed information relevant to accounts receivable, payables, etc. All right. So we're not doing part B, which has to do with memo, but we are doing part C, which is to prepare the income statement for the 6 months ended 30 June 2016. All right, so what are we going to start with? So we're going to start with sales, obviously. And you can see the amount for sales is $212,500. So where did we get this from? Right, so let's check the pre-adjusted trial balance for sales, which is $210,000 given on the credit side. Obviously, this is because sales is always credited, and this is referring to sales revenue. So the $2,500 that we are adding here refers to the unearned sales revenue that we have now earned. So if you remember, we had a liability of $4,100 for unearned sales revenue, which decreased at the end of 30 June to $1,600, which refers to $2,500 worth of revenue that has been earned. So therefore, we add $2,500 to sales. So the total sales in that case becomes $212,500. All right, so that is what we include here. So sales, $212,500. Then we are subtracting sales returns of $1,340, and we get net sales of $211,160. So sales returns refer to a reduction in sales. So if sales is credited, then sales returns, which refers to a reduction in sales, should be debited, right? So we check for that within the debit column, and you should see sales returns of $1,340 that is given to you. So that is what we have included here. All right. So this is the net sales. Now we subtract the cost of goods sold. So the cost of sales is what we have to calculate ourselves. Now, if you remember the second line of the question, it says all stock is marked up by 100% on cost. All right. So this means if the net sales are 212,500, cost of goods sold should be basically divided by 2. But when it comes to dividing whatever you need to divide by 2, that has to be the net sales, because when we have the sales returns, the cost of goods sold should go down. So sales returns need to be included in our calculations. So always remember to use net sales, not sales. So the net sales is $211,160, which is what we divide by 2 because of the 100% markup, and that's $105,580, which is what we have included here straight away. And then we have added the carriage inwards, which refers to the cartage in, which refers to cost of transport of goods into a business, and is going to increase the cost of sales of the business, and that is $3,200. This is an expense because this refers to cost, similar to cost of goods sold, which is also an expense. So if you check the debit column, which is where we record all expenses, you'll see cartage in of $3,200. So now you add the cost of goods sold with the cartage in, and you get $108,780 as the total cost of sales, which is what you subtract from the net sales, and you get gross profit of $102,380. Then you add any other revenue or other income. So always check carefully. So if you have any other revenue or other income, it's going to be on the credit column, within the credit column. So you can see discount revenue of $340 given in the credit column. So that is what we are including here. So discount revenue of $340. And then you have some adjusted income, adjusted gross profit of $102,720. All right, so next we subtract all the expenses All right, so we start with delivery expense of 560 and advertising expense of 45,000. So let's include these two first. So delivery of 560 and advertising of 45,000. Then we have wages expense. Now, the pre-adjusted value for wages is 67,000, but we also need to include the accrued wages from the first additional information of $2,300. So 67,000 plus 2,300 gives us the total wages expense of 69,300. So let's include that here, 69,300. Then we include the depreciation of vehicles, which is 10,620. So make sure to write depreciation of vehicles in exam, not depreciation expense, because they'll cut marks. So 10,620. Right, what other expenses are left? I think we've missed out on interest, which is $240. Right, so let's include that here. So now you add all the expenses together and you get the total, which should be 125,720. And once you subtract the total expenses from the adjusted gross profit of 102,720, you should have a loss, because obviously you can see more expenses, and that is 23,000 loss. And that's all for today's lesson. So I believe you found a lot of value in this content. Make sure to like this video and subscribe to this channel, and I'll see you in the next lesson.